You ever get the feeling that the market's like 1 minute it's smooth sailing, and then the next it's like you're caught in a hurricane?
Yeah, I know what you mean. Lately, especially watching those U.S. Treasury prices, it's been, well, let's just say it's been a wild ride.
Totally. It's like trying to figure out what's going on is like, well, like trying to make sense of, I don't know, tea leaves or something. It's a little crazy out there.
Definitely a bit unpredictable, right?
That's why we're going to really get into it today, right? This whole thing with how the Federal Reserve, the Fed, how their choices, well, how they kind of shake things up in the investment world.
Right, exactly, because those decisions are a big part of why things feel so volatile right now. And for this deep dive, we've got a lot to work with. We're looking at some really in-depth analyses of how the market's been swinging back and forth, and we've even got some glimpses into what the Fed might be thinking, planning, behind the scenes.
And like always, our goal is to cut through all that financial mumbo jumbo, right? Get to the heart of what you actually need to know. So, like, I'm betting some of you out there are probably scratching your heads like, what's with these treasury prices going up? Or maybe, how's the Fed's next move going to hit my investments?
Yeah, those are definitely the big questions right now.
So let's jump right in, unpack all of this, figure it out together.
Sounds good. Let's start with this recent surge in the bond market, because it's been all over the news. Treasury prices are going up, up, up. And the first thing we need to understand is this back and forth, this like seesaw relationship between bond prices and their yields. Basically, when the price of the bonds goes up, its yield goes down. And flip that around, same thing. Price down, yield up.
Okay, so imagine, like, think about two different bonds, right? There's one, an older bond that's offering, say, a 5% interest rate, fixed, doesn't change. But then there's chatter, rumors, right? People are saying new bonds coming out soon, they're only going to offer like 4%. Suddenly, that old 5% bond, it looks pretty sweet, doesn't it?
Exactly. And investors, they're not dummies. They're going to want to grab those older bonds while they can.
Exactly, they see a good deal. So naturally, more people wanting that 5% bond, well, basic economics, that pushes the price up, right? Supply and demand. But here's the thing, and this is where it gets interesting. Even though the price goes up, the interest payment, that 5%, it's fixed. So if you're coming in late to the game, paying that higher price, your actual return, the yield, it's actually lower now.
God. It's like, think of it like finding a super rare vintage comic book, right? Everyone wants it, so you have to pay a premium to get it. But the comic itself, the story, the art, that hasn't changed. You're just paying more to own the same thing.
Ah, that's a great analogy. And this recent activity in the bond market, well, from what we're seeing, a lot of it is tied to this idea that people think the Fed is going to cut interest rates. I even saw some analysts predicting at least two rate cuts before their December meeting. That's a pretty big deal, right?
Huge. Yeah, it really shows you just how much the bond market is influenced by what people think is going to happen. They're basically making moves based on what they think the Fed will do down the line. And you're right, all eyes are on Fed Chair Powell, waiting for any little hint about whether this bond rally will keep going and how it might affect the stock market. It's pretty wild. U.S. government bonds have returned 2.4% this year, which is pretty impressive compared to how some stocks have been taking a hit lately.
So people are definitely parking their money in bonds right now, at least some of them. You mentioned bond yield earlier. Could you, for those who need a refresher, break down what a bond yield is and why we should care about it so much?
Sure, happy to. So the simplest way to think about a bond yield is that it's the return you can expect to get when you buy a bond. Kind of like the interest you get on money you've got sitting in a bank account. But, and here's the key difference, remember those bond prices. They're always changing, which directly affects the yield.
Okay, walk us through an example. Make this real for us.
Okay, let's say we have a bond. Face value is $100, and it pays out $5 in interest every year. Simple math, 5 divided by 100, that's a 5% yield. Now imagine everyone loves this bond, demand goes up, the price is bid up to $110. You're still getting that $5 every year, but now you paid $110 for it. So the yield, it shrunk to about 4.55%. Flip side, let's say things are looking bad, people are selling, and the bond price drops to $90. Same $5 interest, but now you bought it cheaper, so your yield is higher, around 5.56%. See how it works.
It's like a financial teeter-totter. Price goes up, yield goes down, price goes down, yield goes up. Got it. Okay, let's circle back to the big cheese in all of this, the Fed. What do their decisions about interest rates have to do with how much people want bonds, which then affects the prices and yields, right?
Exactly. This is where the Fed's monetary policy really comes into play. Their main tool is changing something called the federal funds rate. Basically, this rate influences all sorts of other interest rates throughout the economy. Now, when the market gets a whiff that the Fed might be about to lower interest rates, a few things happen.
Okay, break it down for us.
First off, there's this assumption that interest rates in general are going down. So new bonds that come out, They'll probably have lower interest payments. Investors, they're smart. They're going to want to snag those older bonds that are still offering higher rates, lock in those returns before they disappear. And as we talked about earlier, more demand, that means the price of those older bonds goes up. But remember, the interest payment on the bond is fixed, so anyone buying at that higher price, their yield is actually going down.
They're paying more for the same amount of income, so their percentage return is less. Right. Now, what about when the market thinks the Fed's going to raise rates? What happens then?
Everything flips. If a rate hike is on the horizon, new bonds will probably offer juicier interest payments. Suddenly, those older bonds with their lower rates, they're not so hot anymore. Demand drops, prices fall. But same fixed interest payment, now it's on a cheaper bond. So people who buy at the lower price actually get a higher yield. It's all about comparing what you're getting now versus what you think you might get later.
So basically, the market's always playing this guessing game, trying to anticipate the Fed's next move, and those guesses, they ripple through the bond prices. Now, one thing we keep hearing about is this thing called the U.S. Treasury market. Can you give us a quick rundown of what that is and how it works?
Sure, think of the U.S. Treasury market as the government's way of borrowing money, the money they need to pay for all sorts of things. They do this by issuing bonds, treasury bills, notes, bonds, all with different maturity dates. After the government sells these bonds, they don't just sit in a vault somewhere. They're traded on something called the secondary market. That means investors buy and sell these bonds amongst themselves, even after the initial sale.
So it's like a giant flea market for government debt.
Kind of, yeah. And just like any other market, supply and demand rules. Lots of demand for treasury bonds, prices go up, yields go down. Less demand, prices go down, yields go up. And here's the kicker. The Fed, remember them, they have a huge influence on this whole thing. Their monetary policy decisions affect interest rates, which in turn affects how much everyone wants those treasury bonds.
Okay, so we're starting to see the whole picture here. Now, our research pointed to three big things that are really shaking things up in the markets right now. Let's unpack those. First one, it seems like when the stock market takes a nosedive, people run to bonds. Why is that?
It's classic flight to safety. When the stock market gets shaky, investors get nervous. They want to protect their money, find somewhere safe to put it, and what's considered one of the safest investments in the world. U.S. Treasuries, because they're backed by the U.S. government. It's not just about avoiding losses. It's also about a lack of confidence in the economy. People are worried things are going south.
So it's all about feeling secure and reacting to those bigger economic worries. Makes sense.
And once again, it comes down to supply and demand. More people wanting treasuries, demand goes up, prices go up, yields go down. Remember that iPhone analogy? Same thing here. When everyone wants something, the price goes up and the return, or in this case the yield, goes down because you're paying more for the same thing.
Got it. The second big thing we noticed, Trump's tariff policies, all that talk about trade wars, it's definitely making people nervous. How are those potential tariffs adding fuel to the fire here?
Tariffs, they bring a whole lot of uncertainty, and that makes the market jittery. When you slap tariffs on imports, it often means higher prices for consumers because those imported goods cost more. And then there's a risk of retaliation, other countries slapping tariffs on U.S. products. That's bad news for American businesses that rely on exports. Bottom line, businesses face higher costs, which can lead to less investment, maybe even job cuts. Not good.
So the market sees these tariffs as a potential roadblock to economic growth, right? Red flags everywhere.
Exactly. And then comes the thinking, okay, if the economy starts to slow down because of all this trade drama, the Fed might need to step in and lower interest rates to try and boost things. And as we know, lower interest rates usually mean bond prices go up and yields go down. It's like if you know your bank's going to start paying you less interest on your savings, those bonds with their higher fixed rates start looking pretty attractive.
Right, makes perfect sense. Now, the third big factor, this one's a real head scratcher, inflation, the big I word. What's the worry here, and what does the Fed have to do with it?
The worry is pretty straightforward. If tariffs make imported stuff more expensive, those costs are going to trickle down to us, the consumers. We'll be paying more for everything, and that's inflation in a nutshell. Now, this puts the Fed in a tough spot.
Okay, why is that?
They're kind of stuck between a rock and a hard place. On one hand, if the economy starts sputtering because of these trade tensions, they might feel pressure to lower interest rates to give things a jump start. But lower rates can actually make inflation worse because it increases the money supply, makes borrowing cheaper, which could lead to more spending and even higher prices. It's a vicious cycle. On the other hand, if they don't lower rates or even raise them to fight inflation, they risk slowing the economy even more and really spooking the stock market. No one wants to see their 401k tank.
Talk about a high-pressure job. So they're trying to find this delicate balance, right? Keep things humming along without letting inflation get out of control. And the market's on edge because no one knows which way they'll jump.
Exactly. It's a nail-biter for sure. And don't forget about the relationship between money supply and inflation. The more money sloshing around in the system, the more likely prices are to go up, especially if we're not producing more goods and services to match that extra cash. It's like too much money chasing too few goods.
Right. Now, I know there are some specific things investors are keeping a close eye on. Our sources mentioned the Fed's dot plot and the yield on the 2-year U.S. Treasury note. Can you explain what those are all about and why they're so important?
You bet. So the dot plot is basically a chart the Fed releases after each meeting of their big decision-making group, the FOMC. It's anonymous, but it shows me where each of the Fed officials on the committee thinks interest rates should be in the future. Each dot represents one official's prediction.
So it's like a peek into their crystal ball.
In a way, yeah, if you see a bunch of dots clustered higher up on the chart for the future, that means most of those Fed folks think rates are going up. And as we've talked about, that's usually bad news for bonds and can put a damper on stock prices. But if the dots are trending downwards, signaling rate cuts on the horizon, that usually makes the bond market happy and can give the stock market a boost, especially for those growth companies.
It's like a collective guesstimate of where interest rates are headed, coming straight from the people who are actually setting those rates. Now, what about this 2-year Treasury yield? Why is that one so special?
Well, the two-year yield is kind of like the market's short-term temperature gauge for the Fed. It's super sensitive to what people think the Fed's going to do in the very near future, more so than longer-term yields. For example, the fact that it dipped to 3.83% back on March 11th, the lowest point it had been all year, that told us that the market wasn't expecting any rate hikes anytime soon.
Interesting. So when that 2-year yield goes down, it's like a vote of confidence that rates will stay put or maybe even go lower. And how does that kind of move affect different investments, like tech stocks, for instance?
When those two-year yields drop, it often means money starts flowing into riskier assets, like you said, tech stocks. Why? Well, lower interest rates make it cheaper for companies to borrow money. That's especially helpful for growth companies. They need money to expand, develop new products, all that good stuff. Plus, when interest rates are low, those future earnings from growth companies, they look even juicier in today's dollars. But if that two-year yield starts climbing, watch out. It could mean the market thinks the Fed is going to keep rates high or even raise them more. That makes investors nervous, and they might start pulling money out of risky assets like tech stocks and putting it into something safer.
So it's all connected. It's like a giant financial ecosystem, everything affecting everything else. Okay, let's zoom out a bit. We've got this bond market rally, the Fed's juggling act, all these economic question marks swirling around. What are some smart investment moves to consider in this kind of crazy environment?
Well, first and foremost, pay attention to the Fed. Watch what they say, read between the lines. If they're hinting at rate cuts, that's a potential green light for tech stocks and other growth companies. But if they sound like they're going to keep rates high, buckle up, because the market might get bumpy.
So keeping tabs on the Fed's every word, that's crucial right now. What else should people be watching?
Keep an eye on those bond yields. One thing people talk about a lot is an inverted yield curve. That's when the yield on short-term treasuries is higher than the yield on longer-term treasuries. And a lot of folks see that as a flashing red light, a potential warning sign that a recession might be coming.
Yikes. Why is that a red flag? What's the thinking there?
It basically boils down to this. High short-term interest rates make it more expensive for businesses and regular folks to borrow money. Companies might hold back on investing in new projects or expansions, and people might think twice about taking out loans or using their credit cards. That can slow the whole economy down, making people worried about the future. And when they get worried, they tend to pull money out of risky assets like stocks and put it into those safer, longer-term bonds. That pushes those bond yields down, creating that inversion we talked about.
So an inverted yield curve means people aren't feeling very optimistic about the economy's near-term prospects. Not a good sign. And we talked about how lower rates can be good for tech and growth companies. What about other kinds of stocks?
Well, our research suggests that when there are worries about inflation or rising interest rates, value stocks can be a good bet. Think sectors like banking and utilities. Banks, they can actually benefit from higher interest rates because they can charge more for loans. And utilities, well, everyone needs water and electricity no matter what's happening in the economy. So their cash flow is usually pretty stable, making them a safer bet when things are uncertain.
So the best investment strategy really depends on what's going on in the economy and what people think the Fed will do next.
No easy answers, huh?
Nope, not at all. The main takeaway here is this. The recent surge in the bond market that's mostly driven by the expectation that the Fed's going to cut rates. That kind of environment is usually good for bonds and can give tech and growth stocks a nice tailwind because it makes borrowing cheaper and gets people excited about future growth. But don't forget all those uncertainties swirling around, the stock market's ups and downs, those tariff policies, the Fed's next move. They all add up to a very unpredictable market. You got that right. So we've covered a lot of ground today, really dug deep into this complex topic. To recap, the bond market, it's like a giant mood ring showing us how investors feel about the Fed's future moves.
Absolutely. And understanding that relationship between bond prices and yields, knowing how the Fed's potential rate cuts, or lack thereof, affect all of this, well, that's key to making sense of the markets right now. And as we've seen, those worries about the stock market, those tariff fears, the whole inflation question, they all add layers of complexity to the puzzle.
So for everyone listening, staying in the know, keeping your finger on the pulse of the Fed's statements and watching those key indicators like Treasury yield, well, that's essential right now.
Couldn't agree more. And while we haven't given any specific investment advice today, the big message is this: do your homework, stay informed, and think about a diversified investment strategy that fits your risk tolerance and your long-term goals. The market's a roller coaster right now, so buckle up and be prepared for anything.
Couldn't have said it better myself. And as you continue to think about all of this, here's something to ponder. Everyone's expecting the Fed to cut rates. But what other signs, besides inflation and employment, might give us a clue about whether that's actually going to happen? Maybe things like consumer confidence surveys or how the manufacturing sector's doing. Those could offer some valuable insights, just something to consider as you navigate these choppy waters. Thanks for joining us for this deep dive.